Hello and welcome to today's program, Understanding Cash Flow, a Business Survival Guide. This webinar is being presented by Tom Fawnin, a SCORE mentor and workshop presenter. Tom is a CPA and a retired CFO of a former DuPont entity, as well as founder and CEO of a tech services business in Kennett Square, Pennsylvania. His dedication to business education is inspiring. Tom is currently a finance professor at West Chester University and has taught at the undergrad and graduate level for many years at prominent universities in Delaware, New York, Virginia, and Arkansas. Thank you, Tom, for sharing your experience on this important topic today. And I trust all of our viewers will find it informative and helpful. Can you advance to the next slide? Thanks. My name is Maria Smith, and I'm a volunteer with SCORE of Chester and Delaware counties. SCORE is a nonprofit organization that has been in existence for over 50 years and is a resource partner of the Small Business Administration. SCORE's mission is to foster a strong small business community by providing free mentorship and business education. We are here to support you and help you grow your business. Here in Chester and Delaware counties, we have 100 volunteers ready to help. Our mentoring and most of our educational programs are free. You will find many tools, templates, and other business resources on our website resource library. Next slide, please. You can advance down to the bottom, thank you. Today's program is 1 hour, scheduled till 11 o'clock. The presentation is being recorded and will be made available to you after today's session. You all have been placed on mute so we avoid distractions. Please ask your questions in the Q&A box and we'll take breaks to answer them. If you have comments or questions for me, you can put those in the chat box. Welcome, Tom Fawnin, our presenter.
Good morning, everybody. Thanks for coming. I start with COVID because we've all been through this together. And as we were going through COVID and as I've been working with various clients in SCORE, it reminded me of a saying by Stephanie Killen in her book, Buddha is Breaking Up, where it says, life is the best teacher. It doesn't tolerate laziness for long. It's always throwing difficult problems our way and then seeing what we'll do about it. And I think that's so true with COVID. And that's why I start this slide with what next after COVID. Just a little short story from my life that talks about life being the best teacher. When I was 8 years old, my dad used to take us all the time in New York to the Golden Gloves. And we used to commute from Westchester County outside of New York by train down to Grand Central Station. And when we entered Grand Central Station, the train was, I was 8 years old, the train was traveling about maybe 10 miles an hour. And it actually hit the train in front of us. And there were people standing in the aisle, and a couple of people got really hurt because they were standing next to the doors, and with the force of the 10 miles an hour, you might not think that that's very fast, but if anybody's ever hit a wall at 10 miles an hour, you would know you get quite a jar. But some of the people's heads actually went through the window. And as an 8-year-old, man, I was still sitting in my seat. My dad was standing up, holding on to the little bar there on the back of the seat. He actually broke his finger holding on, trying to keep me in my seat. But I watched that whole thing, and it reminded me to this day. I mean, I never stand up until a train stops. You know, they tell you in a plane, don't stand up until you come to a full stop at the gate. A lot of people jump right up on the plane to try to get their luggage and beat everybody out the door. But I learned back at 8 years old that I'm not going to do that. And that stuck with me my whole life. And I continue to do that today. I just don't stand up. And I think that really supports this concept of life being the best teacher. And so I start this discussion of cash flow with this study that was done. I have it here for you, and you can certainly get a copy of it online. But it talks about the impact of COVID on a lot of companies, and in particular, which is pertinent to what we're talking about here, cash. Cash is mentioned throughout this study, not only the ability to have had cash in the bank account prior to COVID, but also the ability to quickly work your relationships to get access to cash. And that's what we'll talk about today. And that's going to take cash flow planning, which is what this little talk is about. You can see that the number one challenges during COVID was cash flow. And governments did what they could with the PPP loans and some of the other things they did. But again, companies had to survive until they got that money. And when you read this study, you'll see that almost 3,874 public companies across the world went bankrupt. And some of those companies were quite large, not because they didn't have sales, but because they didn't have cash. And there was tens of thousands of smaller businesses that were not public that also went out of business. So you're talking restaurants, you're talking bars, you're talking all the things that you read in the paper. And cash, well, nobody could have expected, COVID to last as long as it did. But still, it tells us that, again, life being the best teacher, that we better plan for these types of events, maybe not for 2 years long, but these type of events as we go into the future. And enterprises that report not having sufficient funding, you can see that 67% of companies in the world didn't have the right amount of funding to get them through COVID. Again, this is one of the things I circled here for you that we'll talk about as we go forward. I don't have access to any funding. One of the things that I always talk about to entrepreneurs and to people that have existing businesses, it's not only the amount of cash that you have in the bank, it's what you do in times of trouble. Do you have the relationships? Do you have access to the funding that you'll need during that period of time? So generating those or getting those relationships with vendors, with banks, with other sources of funding, and planning for it while the times are good is what you want to do, okay? Cash on hand certainly is an issue, but again, with these type of events, nobody would have anticipated 2 years, and not a lot of people have 2 years worth of cash on hand. But having access to the cash will be critical for our planning going forward. The other thing I always tell entrepreneurs or people in business is, consider, although it might be much more expensive now than it was prior to COVID, business interruption insurance. I know in my business, which I had started back in the early 90s, I did have business interruption insurance. And it wasn't as expensive as it probably is today. But having business interruption insurance, if you can get it, is typically a good investment. With COVID, there was a lot of issues with it. But the good news is that, and I'm not going to read this to you, I'll just summarize it. The United Kingdom, these insurance companies decided that they weren't going to pay. They believed that this was a black swan event or a very rare event that wasn't anticipated to be covered in a business interruption insurance policy. Make a long story short, the Supreme Court in the United Kingdom said, no, that's not true. And they are forcing the insurance companies to pay the customers who did hold business interruption insurance. And here in the United States, there's a movement in the House of Representatives right now to force these insurers to pay under the business interruption insurance. So that's still going through Congress. It's not been approved yet, but the direction is the same as it was in the UK. So again, the importance of some kind of business interruption insurance. So the world has changed right after COVID. We have to say, where before we said, nah, that can never happen here. We know it did happen. And so the business owners, and this was true during COVID, obviously they want to keep their doors open, and protecting their employees was going to be key. And if we didn't learn anything in COVID, it's that cash is certainly critical. So understanding cash flow and your business risks are going to be key as an entrepreneur starting a business, or if you've been in business and got through COVID, congratulations, and you're looking forward, then understanding your cash flow and doing a little planning that you might not have done before will be key. We all saw during COVID that there's a lot of business interruptions, a lot of supply chain disruptions, which cost cash flow implications. Again, being able to, the buzzword pivot from how you were doing your business today to doing your business under maybe different circumstances is all part of the planning process. Understanding your supply chain, your cash flow, your payables, your receivables are all critical to managing your cash. Certainly establishing those relationships to get access to cash in terms of borrowings, the rent, the utilities, all having plans with respect to your vendors in the event that something happens again in the future. So what do we do? Okay. I'm going to suggest, and I've suggested this certainly many years before COVID, and I continue to do it. And with life being the best teacher, we all know that we should have these cash management plans in place. And I'll give you a template to do that. Don't assume the financing options you had previously available to you will continue to be available. Because maybe these options are if you were using vendors, maybe to help finance your business. And again, we'll talk about that later. Maybe those vendors are having issues. Maybe your banks are having issues. So again, we need alternative planning there around cash. Certainly, this is a great opportunity to actively engage with your partners, whoever's doing your financing, whether it's personal financing or mom and pop or banks or using some vendor financing. Let's shore up those lines of credit. Let's shore up those relationships and see if there's any additional options we should look at. Certainly in the case of COVID, the PPP stimulus packages helped us manage our cash flow during those times, assuming that you complied with the restrictions on how to use that cash. That cash becomes grants and it's tax-free. So again, utilizing any kind of government packages that come out, but certainly abiding by the rules and regulations associated with that gives you great access to what I'll call free cash. New suppliers. Again, you don't want to be limited to one supplier. We tell that to the entrepreneurs all the time who come into our SCORE for mentoring, that you want to have, if you can, multiple suppliers in case one of your suppliers has an issue with their own cash flow problems. And then obviously being able to pivot, which a lot of our clients did during COVID, was to shut their storefronts and then use the internet to help run their businesses. In fact, I had one client who is in the chocolate wine pairing business, whose business grew threefold during COVID, and she was able to use Zoom like we're doing now in order to do that. So the world changed, but not how we should think about cash. So when we're talking to entrepreneurs, yourself, look at your, we're going to focus on variable costs rather than fixed costs. Everybody knows the difference between variable and fixed. Variable costs are those costs that we can quickly change. We can do something about today, where fixed costs are things like maybe you're locked into 3 years worth of rent, and that's contractual. Maybe it's your insurance that you're locked into for a period of years. Those are things that, unless you negotiate with either the landlord or the insurance supplier, which will take time, you can't really do anything about. But things like how much inventory we have, how much materials we buy, maybe if we have hourly wages, those kinds of things we need to focus on and understand what they are, so that if we do have a problem with our cash, we can adjust our variable cost. So look for opportunities to reduce contract labor if we have contract labor. And if we can get rid of that contract labor and redistribute it to a permanent workforce, if we do have a permanent workforce, that would be a way to reduce cost as well. Work with our vendors, vendor financing, we call this, to extend your payables. If we have terms with our vendor where we have 15 days to pay, once we take ownership of the goods, we might call the vendor and say, hey, listen, we're running into a cash problem. Maybe can we extend it to 30 days or 40 days? So don't forget about that's a good source of financing when cash gets tight. And if we're a business that generates accounts receivable rather than, when we sell something, getting cash or having a customer pay through credit cards, if we are carrying any kinds of receivables on our books, we have an opportunity to try to incent people to pay us early through maybe some sort of discount structure. And again, you might lose a little bit there, but you'll get the cash in the door quicker. Okay. And as I said before, understand if you don't have business interruption insurance, would that be a good investment for you or not? And so that's always something to look at. Although I do warn you that the business interruption insurance today is a lot more expensive than it was prior to COVID. So let's get started with this cash flow and what do we do now, okay? A lot of entrepreneurs don't understand there's a difference between cash and earnings. And the fact that you can survive without earnings, but you can't without cash. You say, well, how's that possible? Well, I have an example of Tesla there. We all know Tesla, the electronic car company. They've been in business for 20 years. And other than the last couple of quarters, Tesla has not generated any earnings. But they've been able to stay in business for 20 years. And that's because people believed in what they were doing. And so they were willing to risk both bank loans. So banks were willing to risk money into Tesla. And shareholders were willing to put their money out in exchange for stock in Tesla, even though there were no earnings. And I just want to make entrepreneurs aware that, they're focused when they first start the business is generating sales and generating earnings, and they're happy when that happens. But they need to watch what's in their bank account. That's the cash piece of it. And, you can't survive without that cash. Again, you can survive without earnings, but you can't survive without cash. In fact, anybody might have heard of Bernie Madoff, who ran that pyramid scheme. And the only reason why he got caught was because he ran out of cash. And he was able to, bilk $6 billion from his investors. And the pyramid just got too big and he ran out of cash. So he went out of business. But for that, he would have probably never got caught. So let's talk about how to maximize our cost in this presentation. I always share this chart also with students at the university as well as entrepreneurs, where you can see there's a lot of reasons that people who go into business fail. Obviously, no market need. That's obvious. If you had a product or a service that that nobody wanted, you're not going to be able to survive. But the next item down the list is you run out of cash. It doesn't say you run out of sales. It doesn't say you run out of earnings. It says you run out of cash. And that's because people are not focused on making sure that their cash flow and their projections, that they get ahead of the curve in understanding where their sales are, where their earnings are, and how that's going to impact their cash. You'll find a lot of entrepreneurs, and you might even watch Shark Tank and hear this about, these investors, these entrepreneurs will go out and buy a whole mess of inventory, which takes cash to do, and they're waiting for sales. But while they're waiting for sales, all their cash is tied up in inventory and they can't survive. Okay. So if you ever watched Shark Tank, you understand that, when those guys are talking, they're talking about cash and cash flow. So there's only 3 sources for cash on the incoming side, which is important to recognize. You can either generate cash by getting investors to invest in your business, like Tesla did. You could convince a bank to loan you money, like Tesla did, or friends and family. And then the third way is, actually there's four. The third way is operations, right? You sell something and hopefully you make money on it and that you can convert that into cash. And the fourth way that we don't like to talk about is selling assets, because once you start selling assets to generate cash, then you're in the liquidation spiral. So we'll focus on the three, which is debt, bank loans, shareholders, which is equity, giving up ownership in your business when you do that. And then the other is operations. But there's a ton of ways that money goes out the door, that cash goes out the door. It's all your bills, it's all your salary, it's buying inventory. If you are a business that needs inventory, that's one of the areas you need to make sure your planning is as solid as it can be. Because inventory goes bad, and your cash then goes bad. So again, only three ways for cash to come in, but a lot of ways that cash goes out. So understanding that cash flow is going to be critical to understanding your business. One of the things I like you to keep in your mind is earnings are what you make. Cash is what you keep. And it's what we keep, okay, that's going to be crucial to our planning going forward. So earnings and cash, you don't learn anything, are not synonymous. I would say that in the short term, cash is much more important than earnings, as Tesla knows. But in the long term, obviously, you have to have sales and you have to have earnings in order to continue to survive. Tesla, if they didn't start making money in the last couple of quarters, was going to start struggling. But they did, and so hopefully they'll be in good shape now. So if you're a profitable business, that means you have sales, you have earnings. Why would you run out of cash? Well, excessive inventories. Again, you buy inventories expecting that you're going to sell it. And if the market slowed down, COVID, for example, caused a problem with people who were carrying inventories. They couldn't go to the stores anymore. So the company who bought those inventories, their cash was tied up in these inventories. And it's not until they were able to figure out a way to sell them, maybe differently than they did before, that they were going to get some of their cash back. And a lot of times companies during COVID had to reduce the price of their inventory in order to move it. So they were actually taking a hit on their cash. So we're going to make sure we watch our inventory planning. Let's not assume that just because sales in the last quarter were running at a certain rate, that in the next quarter, they're also going to be running at that rate. So inventory management is going to be crucial. If you do have a business that allows customers to pay you over time, you want to focus on those overdue receivables. You know, there's a belief that all customers are good, but I will tell you that all customers are not good. And that's hard for entrepreneurs to believe because, you know, they're out there trying to get as many customers as they can. But if you get a customer that doesn't pay you, that's not a good customer. So focusing on these overdue receivables to generate that, to bring that cash back in is key. Because remember, receivables are just cash tied up in some other asset, just like cash tied up in inventories. It's all your cash waiting to be either sold or collected. Poor invoicing practices. This is another one that entrepreneurs struggle with because they're so busy generating sales that they forget that they need to bill those sales. And they might wait till the end of the week on a Saturday or a Sunday and say, well, I'll just wait to then I'll bill all my clients for either the services I performed or what I sold them. And that's 7 days that goes by in some cases where, you know, you don't have the cash because you haven't billed the customer. Poor credit practices, you know, selling to anybody who wants to buy from you without doing any appropriate credit check to make sure they can afford to buy whatever it is they're buying from you. Carrying obsolete inventories. Again, people don't like to admit that they have inventory that they probably can't sell anymore. But that's tying up your cash. So liquidate it, sell it, you know, for pennies on the dollar. Get some cash back in. If you're not going to sell it during your normal course of business, don't hold on to it, because all you're doing is kidding yourselves. Get whatever cash you can for it, and do it quickly. Same with uncollectible receivables. Accounts receivable, there are companies out there who will buy your receivables. And there are banks, it's called factoring, right? Banks are factors. There are third-party companies that will buy distressed receivables. Of course, you're going to pay a fee for that, but you get the cash. So there are other ways to look at collecting or selling these obsolete inventories and selling your receivables to factors for a fee if you are having trouble collecting from your customers. Again, all trying to get cash into your business as quickly as possible. And then certainly poor investment decisions. We always caution people who are starting a business, who have been in business for a couple of years and are growing, don't get ahead of your headlights. If you're a business that has trucks, where you are delivering goods, or you're a business that's mowing lawns and your business is picking up, and you get excited, you want to go out and buy more lawn mowers, you want to buy more trucks, you want to buy more tractors, make sure that the business will be there if you do that. It might be advantageous for you to raise your prices before you do that, to see how much sticking power your business has with these customers before you go out and make that big capital investment. So cash obviously gives you the flexibility to do what you need. As an entrepreneur, when I started my business, I made sure we had enough cash to be able to react to situations where if I didn't have the cash, I might miss a good opportunity. In my business, when I started it up, there was opportunities to buy up smaller companies across the country who were having problems with their cash. And we had what we call a roll-up strategy, where we buy small companies and then make them part of our organization. But in order to do that, I needed to have cash, and that gave me the flexibility when a company came on the market to quickly make an offer for that company before maybe my competitors could do that. So that requires cash management. I always like this statement from David Baskin, who said, earnings is one thing, but cash doesn't lie. And as an investor in companies, or looking to buy another company, I didn't focus so much on earnings. And obviously, if one of your exit strategies is to try to sell your business someday, you're going to find out quickly that people looking to buy your business are going to focus on cash. Earnings, they'll focus a little bit on earnings, but earnings, because of the accounting rules, there's a lot of assumptions that you make with respect to earnings. There's different policies that a company could employ that are all acceptable under generally accepted accounting principles. And so when you're looking at earnings, you're not really sure what you're looking at, because there's a lot of estimates in there. But there's no estimates when it comes to cash. You either have the cash in the bank account or you don't. So that's why the focus on cash is so important. Poor cash management, obviously stumbling block for entrepreneurs. Understanding cash flow, I'll give you a template in a minute to help us do that, to help you do that. Profit, that's money you make over time, but cash is what you have now on hand to keep your business running, okay? And again, hopefully you recognize by just the first 20 minutes here that profits don't mean cash on hand. So here's another example of where you have a company. W.T. Grant used to be the Walmart when I was growing up in the 50s and 60s. They had the top line you see there is income. So you can see that they had income. It's above the zero, right? So they had income every year. But you can see their cash flow from operations started to go down dramatically. And these guys ended up filing bankruptcy right after that. So here's an example, real life example, where they had earnings every year, but they didn't have the cash. And that was poor inventory practices. When you do look at the case study of W.T. Grant, they bought a lot of inventory that ended up becoming obsolete and couldn't find a market. So remember, when you're buying inventory, you're using your cash, and you're not going to get that cash back until somebody buys it and you collect that money. So there's always a timing difference. And in the case of WT Grant, not watching their cash flow from operations caused them to file bankruptcy. Okay. So liquidity, another name for being able to pay your bills on time. Again, our template will make sure that we're going to be focused on making sure that we're going to pay our bills on time. That will help you as an entrepreneur establish good credit, which that good credit standing will help you be able to get access to cash. So it's a complete circle. If you don't focus on liquidity, okay, then you're going to run the risk of running out of cash or not being able to have enough cash to pay your bills when they come due. And that would be your credit rating then would take a hit. Your ability to access cash would be a problem going forward. So right now you're refocused. If you've been in business during COVID, you're refocused. Your focus now is restarting your business, getting back to hopefully where you were before or better. But again, don't forget about liquidity. Don't forget about cash. You're focused on selling, obviously, to continue the growth that you're on, maybe satisfying your customers who hung with you during COVID. But again, all these are very important for you to do. But if you don't make cash flow management a priority, okay, as we said before, you'll be in big trouble. So we want to learn from life and what happened during COVID. And we don't want to be one of those businesses that get caught short going forward, having run out of cash or no way to get cash. So knowing when, where, and how your cash needs will occur, planning for it, okay, that's looking forward, knowing the best sources of meeting those cash flow needs, being prepared to meet those needs with good relationships with bankers, creditors, and suppliers. This is the time to do that. When things are going good, this is the time to establish and solidify those relationships with those three groups. Because in bad times, that's not going to be the time to do it. So what does this template look like? What should we be doing? Well, we want to look at cash flow. We want to look out weekly, monthly, but certainly we want to plan out over the next 6 to 12 months, okay? Longer term, I'm not so much worried about longer term now. This is for much larger companies where they're looking out 3 to 5 years. But for mid-level and smaller companies or companies just starting out, we don't know enough to predict a year from now, let alone 3 years from now. So we're going to be looking at the 6 months. I always tell the entrepreneurs that I deal with and the students at the university, when you're starting a business, look out 6 months, okay? And use the following template. So we'll take some time to go through this. If you're in a business and you have your own accounting firm or accounting person that you're working with, we're not going to be so much concerned with the accounting definition of cash flow. What we want to talk about is much simpler view. Generally accepted accounting principles has ways they do their cash flow statement, and a lot of it is good for that reporting. But what we're concerned about is the checkbook approach. We want a template. You can see this looks out 6 months. And we want just make it simple, right? What is the money we have in our bank today? So if we look at June, we're starting with $19,000. And then what can we expect to collect in the month of June? So if we had some sales that we did in the prior month that become due in June, then we should just populate the Excel spreadsheet for that. If we're a business that takes deposits in advance of performing a service or in advance of performing or selling a product, then if it's coming in June, we put it in June. If we have any loans that we know that we've made that are coming in, then we put those in June. And then whatever sources of cash you know are coming in, it could be a tax refund for your business. It could be, maybe I think probably the PPP loans are all done, but wherever sources of cash you have, it could be coming in from friends and family. It could be wherever. So, but think through it for the next 6 months. And of course, you're going to have to think about what kind of sales you're going to have over July, August, September, October, November. But again, we're not going out too far. We should have a good feel for what we think our revenue would be in those times and how much of that revenue we can collect. We don't care about the earnings impact. We care about how much of that revenue we can collect in these months. Okay, your accountant will be focused on your earnings, but what we want to focus on is the cash component of that. And then we'll simply just total those up, right? And then we're going to list as many items as we can think of where we're going to need to spend money. And it's when cash is going out the door, okay? So if you have a payroll and you know you have to make that payroll in June, then we'll just record that. To the extent we're buying inventory or buying supplies, and we know that we got payments to be made or we can estimate what those payments are, then we're going to record those. Any kinds of utilities, rent, insurance, stuff that you know is going out the door. And think about writing a check, okay? You might write a check for insurance for the whole year in the month of June. Well, you don't have to worry about then rent payments in July, August, September, October, November. The whole payment went out in June. So it's not the accounting view of when that rent is going to be recorded in your income statement. It's the cash view. We're only concerned about writing those checks here. Anything you pay yourself, owner's compensation would go on this sheet here. If you have some repayments of debt, then that would go on here. If you promise to pay back your mom and dad or friends and family for money they gave you during COVID, that would go on here as well as any plans to buy assets would have to go on here in the month you're planning on spending the money. And then income taxes. To the extent that you're paying Pennsylvania unemployment taxes or Pennsylvania income taxes or federal income taxes, federal unemployment taxes, only put it in though in the month that you're going to actually make the payment. And then find whatever else you have. So this sheet is totally flexible, right? You set it up in Excel, you know your business, you put the sources of cash from your business, you put the sources or the uses of cash down below, and then it becomes an exercise in just adding it up, right? So you end up with, in the month of June, 94,000 of cash coming in, 93,000 of cash going out. So you would end up with 1,000 excess cash. That's what you're going to see in your bank account, right? Because you started with, I'm sorry, you're going to see, you'll see 20,000. If your opening balance was 19, no, that's not right. So your opening balance was 19, you added the 65 and the 10 to it to get 94. So your bank account at the end of June will be down to $1,000, okay? And you can just follow that out through the next 6 months. The important point is here, you're thinking about cash, okay? You're not thinking about earnings, you're thinking about cash. And you're looking out to see when or if you have any problems. And if you look out to November, you can see if your plan, your estimates that are in this sheet, in fact happen, you're going to be short cash out in November. Well, I can tell you from experience that knowing in June that you're not going to have enough cash in November gives you time to make changes. It gives you time to react. Rather than just waiting until November to find out you have a problem, you're better off knowing today. So you have time to deal with it. So we could look then at our chart. Well, maybe we don't buy that $10,000 of new equipment in the month of November. Maybe we wait until a future month. But knowing that now prevents us having a cash problem in November. So, you know, those people that during prior to COVID who had a 3-year cash plan, they could have never expected, because these are all estimates, right? They're guesses. They could have never expected that their sources of cash, from receivables or from sales, would be dormant for maybe a year, maybe longer. And so it doesn't, in things like COVID, it doesn't negate the fact that we're going to still have problems. But during normal business operations, okay, they could, if you had this plan, you could have survived COVID for the first 3 months, maybe 4 months. But beyond that, then it gets difficult. But that's not the purpose. The purpose of putting these plans together is not to predict the worst case that could ever happen to you. It is to look at what your business will likely do and give you the opportunity to make course corrections should your estimates not be accurate. But again, looking at cash, as we said, is crucial to understanding your business, okay? So let me stop there and see if there's any questions so far on this chart or the importance of cash or anything I said so far.
Hi, Tom, it's Maria. We don't have any questions in the box right now, but while we're waiting for people to ask some, do you have any advice for seasonal businesses? I could imagine their cash flow could look a little different.
Yeah, you'd use the same format, except that it would then show the cash coming in on a seasonal basis. And you might have, the cash monthly being the same here, but hopefully if it's seasonal and you have, 12 months worth of costs, you'll have enough cash coming in during your high seasons, right? So if your high season was September, October, November, you would expect a lot more cash to be coming in during that time, even though your uses of cash might be consistent throughout the year.
Thanks.
But knowing that now will help you plan better. So obviously you want to spend, if you have a seasonal business and you want to purchase fixed assets, you want to do it during the high points of your season when you're collecting the cash. If you got to repay debt, set up your debt principal and interest payments commensurate with your seasons.
Mm-hmm. The reason I asked the question was I worked on a couple of businesses that were seasonal in my career, and they were very Christmas focused, and we had to buy a lot of inventory well in advance of the season, which would go on store shelves, which of course would take a while to turn. So that's why I asked that question.
Yeah, so your plan would make sure before you have to go out and buy that inventory, make sure your plan is looking at having sufficient cash and a couple of months prior to when you need to go out and buy all that inventory. What you don't want to find out is when it comes time to buy that inventory, you don't have the cash.
Right. Okay. Looks like a quiet group today. I don't see any questions in the box.
Okay. Planning is key. So if we look at sources of cash, we're looking at savings. So if you're starting a business, you might use your own personal savings, friends and family, certainly banks, investors, could be crowdfunding or something like that on the using the internet. Obviously, we talked about sale of assets. You certainly don't want to be selling assets because that's sort of a double-edged sword. That tells people you're struggling to get cash from these other sources, or you're about to go out of business. So selling assets generally is not a good thing. And then obviously sales. And the key here is that the only real sustainable cash flow or cash is from sales. Savings, you're going to run out of savings, so that's not sustainable. Friends and family, they're going to get fed up with you. Banks, the more you borrow, the higher your credit risk, so that will eventually run out. Investors will get impatient, and new investors may not be willing to invest if you're not showing any kind of cash growth on your own. Sale of assets, as I said, is a way to go out of business. So obviously, sales are going to be key. But it's when you're going to get the cash from those sales that we're looking at in the prior document there. Most of you are familiar with an income statement. And the reason we say that earnings and cash are not the same thing is because, as I said, there are things on the income statement that are not cash. They are accounting conventions, but they don't reflect cash. So that when you're looking at net income there of $30,000, don't assume that's all income, because there are items that have been deducted from your sales that are not cash. One example that I point there is depreciation, which is a way of recognizing for accounting purposes the capital expenditure that you made, in this case, $150,000, which is going to be providing a service to your business over 5 years. That's where the 5 comes from. So in accounting, we try to match the expenses with the revenue that they're generating. Well, we spent the cash 5 years ago, or 2 years ago, but we spent $150,000. That would have shown up at whatever month and whatever year on our previous spreadsheet in the month we spent that money. But for your income, it's apportioned over 5 years. So you're only seeing $30,000 as an expense in that year. But that $30,000 has been deducted from your sales of $500,000 there to say your net income is $30,000. But your cash, if that was the only non-cash item there, your cash should be $60,000. Okay. But there's other things in there that are non-cash charges that will be distorted, will be another difference between your income and your cash. So as an entrepreneur, remember, earnings, net income is not cash. Okay. Earnings is what you make, cash is what we keep. So just remember that. And that's what I just talked about there. So I'm not going to talk about that again. So where we run into cash flow problems, our cash forecast, we didn't prepare a cash forecast, or we made bad assumptions. And that's okay, because you're going to learn from the assumptions you make and correct them going forward. One of the things we don't want to do is, if we don't plan, or even if we do plan, don't run ahead of our headlights, right? I could be a lawn mowing business, and all of a sudden, one week I get 3 new customers, and I say, oh, geez, well, I'm going to get 3 new customers then every week for the next foreseeable future, and I better go out and buy more tractors. Well, that might not be the case. You might have had a good week where you pick up 3 new customers, but the next 3 weeks, you might not pick up any new customers. So again, make sure that whatever business you're seeing, whatever growth that you're seeing is sustainable before you go out and either hire people, buy that next asset, expand your office space, or expand your retail space. Whatever it is, make sure that what you are seeing is sustainable and not a fluke or a one-off type of growth. So adjust the plan, be realistic. Don't try to, obviously the worst thing to do is fill out that chart and try to kid yourself, okay? And I heard this all the time. Interest from potential customers is so high, so I hired additional salespeople. So this is one where, you meet with potential customer and they say, well, we want to do business with you. And if we do, we're going to give you so much business. And you take that to the bank. That's something you don't want to take to the bank. As soon as they say, we want to do business with you, we need to change that into, here's a contract. Because wanting to do business and actually doing business are 2 separate things. So don't hire people based on a hope that the meeting with that customer pays off. Wait until you get that contract. You might have you might do some homework and know the people you might want to hire if that's what it takes. Maybe you've had interviewed them already, but you don't hire them until you're sure that you have the business, because hoping that something will happen is not a business principle. You need to have the signed deal in order to know that that's happening. If you're looking at your sales and you're saying, well, maybe I need more, maybe I'm getting too many customers. It may be the fact that your pricing is too low, okay? We always looked at our pricing every year. If we went into a potential customer in my business and that customer was pretty quick to accept our offer, then we pretty much believed that our pricing was too low. So we raised, when I bought this business and started it up in Kennett Square, our pricing was too low. We were getting customers that were pretty easy to get, and we said we got to go revisit our pricing, and we did, and we raised the prices, and we didn't lose any business. But then as we went to get new business, it became a negotiation, which is what I wanted, because that let me know that the pricing, I was pricing sort of in the right place. Obviously, if the sales are too low, you want to look at the market, look at your value proposition, and look at the way you are approaching sales. And again, sales is the key to drive cash, right? And so one of the things to increase your cash flow is to look at these things on your sales side, some of which might be obvious to you in your business. The other thing to do is to look at your cash cycle time or cash conversion time. How long is it taking me from when I write my check to get that money back from into my bank account? And it depends on what kind of business you are, that will dictate what kind of cycle time you have. If you're a business that has to buy inventory, remember, there's a time from when you write the check to you have the inventory sitting on your shelf. And then there's a time for when it sits on your shelf for somebody to buy it. And then if you allow a customer a certain amount of time to pay you for that inventory, that's more time. All this time that you're waiting you're waiting for your cash. I mean, that cash is yours. It's just tied up in either inventory, it's tied up in accounts receivable, and until you collect it, you're not going to get the cash back in your account. And you can actually put days next to this chart to see how long it takes you on average to collect your cash. Now, if you're using, if you only take cash, or you're allowing for customers to use credit cards, then obviously your cash flow cycle time is not as fast. I mean, is faster than if you're allowing a customer a certain amount of days to pay you. But all that can be calculated, and it's an important number to know how long you are without your cash. So how can you improve that cash flow right now? Understand that cash flow cycle time. Obviously, increase your sales margin by looking at your prices or reducing your cost of sales. That's one way to do it. You can change your sales terms, but you need to be careful there. What I mean there is, if you're allowing a customer 30 days to pay, which a lot of companies do, you change it to 15 days to cut it in half, because you want to reduce your cash flow conversion time. You have to be careful there, because there's competitive dynamics in the marketplace that could prevent you from doing that. If your customers or your competitors are selling with certain sales terms and you go outside the norm, you could stand to lose the business there. So be careful with changing sales terms. One of the areas where entrepreneurs have a lot of flexibility after they've established their business is to negotiate better terms with vendors. So if you're buying material from vendors for your product, or you are buying inventory to resell, or you're, whatever it is, you can negotiate with vendors for longer payment terms. So if you're paying everything in cash, typically when an entrepreneur starts, maybe a vendor wants cash because they're not sure about how successful you're going to be. But over time, they're going to see you're successful, and then you tell your vendors, listen, I don't want to pay cash anymore. I want to give it to you and pay you the cash in 15 days. Well, all of a sudden, you've increased your cash management by 15 days. So you have 15 days to do whatever it is with the product that you bought from this vendor. And you hopefully within that 15 days, you can sell it if it happens to be something that's sellable. And you can hold on to that money, put it in the bank until you have to pay the vendor back. So getting that, what we call arbitrage on money, is something that the more successful you are, the better negotiating position you'll have. But don't forget about those vendors. They a lot of times are willing to extend terms to you, give you more time to pay for it, which is great for you. If you're really running into a cash crunch, look at vendor terms. I'm sorry, look at controllable fixed cost, and that's always tougher to handle with in the short term, like we talked about in the beginning. But again, it's something that when you do your projections in your Excel spreadsheet there, you can see if you have any issues like that. Certainly reducing working capital, which is your inventory, your receivables, is a way to get your cash flow now. Reduce capital expenditures if that's what you need to do based on your projections. And you might want to change the way you pay. If you have a sales, people in the sales selling product for you, you can change from a fixed salary to some sort of incentive payout there. So that's pretty much it, except for the last piece. I'd be remiss if we didn't talk about cash and its impact on your exit strategy. And a lot of you probably not even thinking about this, but I would suggest you give it some thought. You know, where do you want to go with the business? Are you looking to have it be generational, where you're going to hand it down to your children, or is the purpose for what you're doing to eventually sell it and you know, make some good retirement income for yourself? So you can't not talk about exit strategy. And in order to, if your plan is to sell it, then it's critical that you show strong cash flow. Companies are going to look at certainly your sales growth. They're not going to focus so much on your earnings growth. They're going to focus on your cash flow growth. And how much of those sales are you converting to cash? In their due diligence process, which is the process they'll do to look at your books, they're going to focus on cash flow. They're not going to focus on earnings. So another reason for you to get very familiar with and do a very good job planning your cash flow. So it's not just for, you know, getting by for the foreseeable future and understanding what your cash flow needs are and where you're going to have potential bottlenecks or problems, and giving you time to make those adjustments. It's also getting very familiar with cash flow as a means to exit the business should you be so inclined. Okay. So my voice is running out. So this is what I wanted you to take away from this session, that there is a difference between cash and earnings. You can survive without earnings for a time, but you can't survive without cash. And cash planning, cash flow planning, while it couldn't have prevented everything that happened during COVID, hopefully COVID doesn't happen every couple of years where we have to shut down our economy for a year at a time. Hopefully we've learned from that. But in normal times, okay, and I put normal in quotes, it's always best to do that cash flow planning to make sure that you have enough cash to be flexible, not only to meet your current bills as they come due, but also to take advantage of opportunities that may come your way that would help you be able to grow your business. Okay. Questions?
So we have one in the box that you might have covered after it came into the box. It's about providing an example of a supplier extending a courtesy. Now, you did tell us a little bit about negotiating or extending payment terms with a vendor. Are there any other examples, Tom?
Yeah, so in my business, we used to buy a lot of parts. My business was a service business to the graphic arts industry. And we had to keep various parts on hand for printing machines and for or things used in printing presses. And so we had to buy those. And when a machine broke down, our job was to go out and obviously service the machine and replace the parts. Originally, when I had bought this business, I bought this business from DuPont, and set it up in Kennett. The DuPont had very good terms, obviously, because they were so big. But when I went out on my own with the company, the vendors came back to me and said, we can't extend those terms, same terms that DuPont had. We have to shorten them. So you're going to have to pay us within days as opposed to within weeks. And I understood that because I was just starting the business and they didn't know whether I would survive or not. But after a year and a half in the business, I went back to all the vendors and I said to them, listen, we've been in business for a year and a half now. I want to go back to the terms that you had given to DuPont, which was to pay in 45 days. Because on average, my parts are staying on the shelf for about 20 days. So when I was paying you in 10 days, I was actually out the cash. My company was out the cash for those 10 days between what I had when I had to pay you and when I could sell them. But now I want 45 days because we've showed you we can work. And they did extend them not to 45 days. They went out to 34 days. Which again increased my cash flow because now I could buy the parts, I could sell them to my customers in 20 days, and then I could keep that money for 14 days, which is the difference between when I had to pay the vendor and when I got the money, and earn interest on it in my bank account. So I could double up in a way. I extended the payment to the vendor. I can earn some money on interest when I deposited that money in the bank until I had to pay the vendor. So the advantage and don't cut yourself short. The advantage I have if the vendor came back and said, well, no, I don't think I want to do that. All right, well, then I'm just going to buy from your competitor. So you have to make sure that there is an alternative source for those whatever you're buying before you take a hard line on negotiating. But it's worth doing. So that's an example from my own experience.
Great, thanks. I think we're coming right up at the hour. So maybe we should just move ahead to the next slide, Tom, to give people time to answer a couple questions for us. So first of all, thank you, Tom. You gave us a lot to think about and excellent data references too. As mentioned earlier, you will all receive the recorded webinar following today's session. Here at SCORE, we're here to help you with the next steps on your business plans and challenges. Please reach out to your SCORE mentor for support on this topic or any other topic that's on your mind. You're not alone in this process. If you aren't already working with a SCORE mentor, you can request one by going to our website link shown here or by calling the phone number and speaking with Catherine in our office. This information will also be included in the follow-up email from SCORE. Note that SCORE is now conducting mentoring sessions face-to-face. If clients are interested in doing that, just work that out with the mentors that you are engaged with, if that's your preference. We can go to the next slide, and while you do that, I'm going to pull up a poll. We are always interested in getting feedback from the people who attend our webinars so that we can make improvements in future business training sessions. If you would take a moment to just answer these questions quickly. There's 7 questions here. It should only take a moment or two. I'll take a very fast pause so people can work on that. And then we'll wrap things up. There's a question in the box about receiving the slide deck. Are you okay, Tom, if we send out a PDF version of the slide deck?
Sure.
Okay, great. The answer is yes, we'll do that. Okay, we'll just give it another minute here while people are answering the poll.